Hello everyone, welcome to session 3 of IFRS 15 Revenue from Contract with the Customers. My name is Karan Sehgal and we will cover step 2 of the standard, which is identifying the performance obligation in the contract. And the specific topics within this step we will cover today would be how to identify performance obligation in a contract, what do we mean by implied promises and administrative tasks, how to identify distinct goods and services, series of distinct goods and services, and few case studies. Once the entity identifies the contract with the customer, the next step is to identify the total number of performance obligation in the contract. Now, this is a very important step because if the total number of performance obligation is not identified correctly, then it might impact the timing of revenue recognition. So, what's a performance obligation? A performance obligation is like a unit of accounting for revenue recognition. Performance obligation is a promise to a customer to transfer goods or services that is distinct in nature, or a series of goods or services that are substantially the same and have the same pattern of transfer to the customer. The first thing entity needs to do is to identify all the goods and services promised to be transferred to the customer in the contract. Now, there are few important things which should be kept in mind. These goods and services can be explicitly mentioned in the contract, or it could be an implied promise. Now, what do we mean by implied promise? An implied promise is something which is not mentioned in the contract and cannot be easily identified. It is an established business practice that creates a valid and reasonable expectation that the entity would transfer certain goods or services to the end customer. So, if there is a valid expectation from a customer perspective based on historical practices, then it becomes a performance obligation as per the new standard. Another important discussion point is around administrative tasks. These are fulfillment activities which are in the nature of administrative tasks or setup activities. They are necessary activities for the successful completion and the performance of the contract, but there is no transfer of goods and services in the case of administrative task. Now let's analyze this case study to better understand the meaning of performance obligation and the implication of performance obligation. A agrees to build a customized software for B. The development of the software will be done in B's premise. A creates a setup environment at B premise for its staff. A has a historical practice to provide 6 months of free maintenance to all its customers. Now, when we analyze this case, we can easily identify software as a promised goods or services. But there are also setup activities performed by A. Now, as mentioned earlier, these setup activities are more in the nature of fulfillment activity and there is no transfer of goods or services. Now, let's talk about the historical practice of providing free maintenance. Even though in the contract there is no mention of providing maintenance to the customer, which is B, but since if as there is a historical practice of providing free maintenance, this creates a valid expectation from a customer's perspective, and this would fall within the definition of implied promise. So, implied promise would be a performance obligation, and in this case, A needs to identify free maintenance of 6 months as a performance obligation. As discussed in the earlier slide, that first the entity needs to identify all the goods or services promised to be transferred to the customer. The entity needs to keep in mind that it should include all the implied promises in the contract and should not list down administrative tasks as promised goods or services. Once all the promised goods or services has been identified, the entity needs to assess whether it's distinct in nature or not. Now, how to identify whether the promised goods or services are distinct in nature or not? A good or service is distinct in nature if the following criteria are met. The first criteria is it capable of being distinct? Can the customer benefit from the good or services on its own or together with other resources that are readily available in the contract? A customer can benefit from good or services if it can be consumed, sold for an amount that is greater than the scrap value, or otherwise held in any way that generates economic benefits. The fact that a good or service is regularly sold separately by the entity is an indicator that the customer can benefit from good or services on its own or with other readily available resources. The second criteria is whether it is distinct within the context of the contract. That is the entity's promise to transfer the good or services is separately identifiable from the other promises in the contract. In this criteria, the entity needs to determine whether the promise to transfer each of the good or services individually or whether the promise is to transfer a combined item or items to which promised goods and services are inputs. The following are the indicators to assess whether two or more promises are separately identifiable or not. Does the entity provide significant service of integrating one good or services with other good or services in the contract into a bundle which represent a combined output? One good or services modifies the other good or services in the contract. One good or service is highly dependent on other promised good or services in the contract. A good or service is distinct if both the criteria, that is, it is capable of being distinct and distinct within the context of the contract, are met. If any of the criteria are not met, then it would be combined with other promised good or services in the contract until it identifies a bundle of good or services that is distinct. Now let's look at a case study to understand the concept of distinct goods or services. A enters into a contract with B to provide a mobile phone. Now, along with the mobile phone, A is also providing data service and an extended warranty of 2 years. In this case, there are three promises in the contract: mobile phone, data services, and extended warranty. Each of the promises are capable of distinct on its own and distinct within the context of the contract, as each services are separable. Now let's look at another example. A enters into a contract with B to build a customized software. Along with the software, A would also provide installation service. The installation of the software is very complex and can only be done by the developer of software, that is A. A would also provide upgrade of the software over the life of the contract, which would impact the functionality of the software. In this case, there are three promises in the contract: software, installation service, and software upgrades. Now it's clear that software is a distinct goods or services which is capable of being distinct and distinct within the context of the contract. However, when we analyze other promises like installation services and upgrades, each of these services is highly interrelated with the software and are not distinct in the nature and needs to be combined with the software. So in this case, there will be a single performance obligation consisting of software, installation services, and upgrades. Now let's discuss on series of distinct goods or services. A contract may contain promises to deliver a series of distinct goods or services that are substantially the same. At the inception of the contract, the entity need to assess and determine whether the series guidance would be applicable or not. If all the following criteria are met, then the series guidance would apply and it would be considered as a single performance obligation. The criteria are as follows. Are the good or service substantially the same? Each distinct good or services in the series guidance is satisfied over the time, and the same method is used to measure the progress towards the satisfaction of performance obligation for each of the good or services in the contract. Now, we should keep in mind that there is no exemption from applying the series guidance. So, in case at the inception of the contract the entity assesses that all the three criteria are met, then it has to be treated as a simple performance obligation. Well, this brings us to the end of the presentation. In this session, we have discussed about step 2 of how to identify the performance obligation of the contract. In the next step, we will discuss a very important topic called how to determine the transaction price. Stay tuned for the next session. Thank you.